Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Wednesday, April the 3rd. The year's 2024. Let's talk trading. Buyzone stats with Walmal. These videos are for educational purposes only. Your results may differ from mine and different from Walmal's. Walmal, one of our viewers, wanted me to go over the Buyzone stats. I guess since I mentioned yesterday, I hadn't run them in a while, and I guess there might be some interest in the whole methodology. Did I lose you?
Nope, I'm here.
Oh.
I'm waiting for you to finish.
Oh, that.
Yeah, the Buyzone. I mean, it's a tried and true method, and it's something that we certainly can make money. And it's not just limited to, the forex market for sure. In fact, I think when you first started talking about it, you were talking about it in terms of the U.S. stock market.
Yeah, equities. Yeah, that's what I was using, and I ported it over to forex to see. And a lot of people want to know, well, why did you switch? I go, well, somebody told me that the forex market was the biggest market, and I just wanted to play with the big boys.
More volume, more money.
Yeah, and plus, it's one of those things where in the stocks, there's thousands of stocks, but there's only a limited number of currencies that we trade. So you don't have to look for what I used to call the stock du jour, the stock of the day, because, that was something that a lot of people didn't understand, the difference between trading and picking. And that, they were looking for hot stocks, and yeah, I was looking for them, and I wrote a bunch of filters over there on Stock Fetcher, and they're still in use to pick out stocks, but it's more, I guess the idea is that it's more, for me, it's more about finding the instruments to trade that fit the method rather than finding the method to fit what I'm trading.
Right.
Because, because certain stocks work better with certain methods, and and so it's like if all I have is a hammer, then I want to go get some nails. I don't want to get screws. You know what I mean?
Yeah, exactly.
Yeah.
You got to work with what you got, right?
Right. So, and so that's what I learned, because, some people would say, well, this method, and they try and use it on all these different stocks. And it's like, well, it doesn't always work very well. But the funniest thing about Stock Fetcher, before I dive into it, was with all these filters, I forget which filter it was I wrote, but Muddy, one of the guys that was around when I first started Stock Fetcher, he looked at the filter and saw that if you looked at it from like 30 days ago, it was just a C or red. And so what he did was he'd find stocks that it would pick, and then he would just short the heck out of them. But so, what is the Buyzone, and how did I come up with it? Well, price goes up, price goes down. And at the end of the day, on the equity market and on Forex too, you've got an open price, you've got a high of the day, low of the day, and a close price. So, a lot of people talk about range, but, I split it up. And if you use my magnified market price, it's high minus close and close minus low. You add them, those two together, and you get the range. So right now we're looking at about a 26 pip range for the day, which is, we used to get that on what, the hour?
Exactly.
Back in the good old days. I mean, now we really sound like geezers talking about the good old days, right? But
the problem is that sometimes the good old days is only 6 months ago.
Exactly. So what I'm doing is I ran a frequency distribution, which is something I learned in college back in way back when in my statistics class. And it's like one of those classes I took to, fill up I just needed to take some classes, so I thought I'll take statistics, and never really thought I'd be using them, but I'm glad I took that course, because I use this stuff all the time now in trading and in other things too. Um, so what I decided was, it's like, well, if price moves a certain distance away from the open, what's the chance it's going to move further? So you can see here I've got the frequency distribution indicator. I'll put the list up there. I'm just using the 2023 version here. And here's an old 2019, the histogram at the bottom. It's just basically showing the wicks. Or actually not showing the wicks, it's showing high minus close and close minus low. So here, is the difference greater than 0 out of the last 1440 bars, and that's how many minutes there are in a day, if you're wondering where that number came from. Usually I run this on the 1 minute chart, but we're looking at the daily stats here. So greater than 0 all the time, greater than 1, 1433. So you can see there's a difference of 7 right there. And then here you go for greater than 2. And so usually I was looking for about the 80% level. It's like, okay, does it go past this mark 80% at a time? And you can see here, it goes past 10, 91% at a time for high minus open, and open minus low 84% at a time. But you have to remember one thing. We've got 26 pips on the day, and if the difference between the high minus open and open minus low, if we're looking at 10, well, that's 20 of those 26 pips. So you can see there wasn't much of a breakout. I mean, there was no breakout to the downside and only 6 pips to the upside. So that's just a really tough day. And actually, this is a high minus close, close minus low, as opposed to high minus open, open minus low on the magnified market price here. So point being is, if you catch, if you get in a trade, at near the open price, chances are price is just going to move away from the open. So with this, you're always trading away from the open. Whereas with the rats, you're trading towards the open. And that's...
So essentially what you're saying, you're always trading with the candle color.
Exactly.
And I'm just trying to make it simpler for folks to understand. So if you're just trading with that candle color, it makes it much, much easier, because essentially what that means is you only need one thing. Candlesticks. That's it.
Right. And so if I go back here to the Buyzone chart, you can see here how we crisscrossed the open. And there's where we broke through the low. And here's where we broke through the high. So actually, for the day, we've got, looks like high minus opens only about 11 or 12 pips, and ditto on the downside. This looks like it might be about 13 pips or so. So with this narrowed range, daily range, what we as traders might want to do is move these lines. Instead of open plus 8, open plus 10, we might want to look maybe to move it down to 5. And if you did that, you might you get more triggers That's for sure. So if you look here at 5, it's 97% of the time it's 5 or more to the upside, high minus open, and it's 92% of the time open minus low, greater than 5. And that's using the daily open. And just some more stats. You can see the maximum high minus open was 469 pips, and the maximum open minus low was 605. Because we're doing, see, 250 days a year. We're looking back, what, over 5 years worth of data here. So maybe we should do it. How many days should we do, Walmal?
I would say probably, because the thing is, market's changing so quickly, I'd be willing to look back maybe 1 quarter. That's it. Because generally speaking, we get different patterns every quarter.
Right.
That would be my suggestion. But by doing that, what's really cool about that is that means we'll be tighter into the market, and we can go and have a better idea of where these zones should be set up.
So you want to do 100 days?
Yeah, that sounds reasonable.
And see how much that changes. So difference, high minus open 10 pips or more, 91%, and open minus low greater than 10, 89%. So it's still showing that, there is some movement here. And usually what happens is you'll see if these numbers are the same, like I'm looking at the difference for 3, 4, and 5 pips are all at 96. So what that tells me is if it's open plus 3, chances are it's going to go to open plus 5 or higher. And then over here, okay, we've got, if it's greater than 1 pip, 98, greater than 2 pips, 98, greater than 3 pips, 97. So then you can see here, from 4, greater than 4 is 96, greater than 6. So on the open minus low side, if it hits 4, chances are it's going to hit 6, based on statistics, over the last 100 days. So if you really want to play the statistics, you'd go short at open minus 4, and you'd go long at open plus 3. Only problem with that is that I would see, if you've got a broker that has over a 1 pip spread, it might be, that's when you could possibly get cut.
Yeah, it becomes unrealistic. I hate to say it, but
Right.
It becomes unrealistic. So that's when you start looking at a broker that's an ECM type broker. Yes, you have to pay commission then, but you're typically speaking, your spreads are extremely small in comparison, and so that it will help you out tremendously.
Right. So, fellow traders, fastest 15 minutes in trading's almost over. But if you've got any questions, about this, feel free to ask. Hopefully, I've answered the questions and explained it, because it really is simple. Like Walmal said, all you need to do is look at candle color. And it's a horizontal line trade. You draw some horizontal lines on the chart, and when you see price hit that horizontal line, you take the trade in the direction price is moving. So traders, always remember and never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.